Today I'm going to talk about the merry-go-round of a stock market we have going on, where we keep going round and round in circles. And part of this is because the Fed's trying to control inflation by increasing interest rates, while the United States government keeps spending more and more money on more projects. And then the United States is trying to do quantitative tightening and reduce the money supply, while China is doing quantitative easing by lowering their interest rates and trying to stimulate their economies. Plus, in all of this confusion, we have Warren Buffett, a very conservative investor, actually buying another FANG. He doesn't buy that much technology, but he's investing in another FANG. What stock is it? Hang on. This is not financial nor professional advice. This video is for entertainment only. Hey everybody, welcome to my channel. And smash that like button if any of this is going to be helpful for you, because it really helps the channel. The FANG stock that Warren Buffett is buying is the stock that puts the G into the FANG. It's Google. It's Google. G-O-O-G-L is the symbol. That's the Class A shares. And he bought it mainly in the fourth quarter of 2022. And now the NASDAQ has rallied 14% at the beginning of this year, but now it's come down and it's only ahead by about 5%. So you can get Google at about the same price probably that Warren Buffett was buying it in the fourth quarter of 2022, or pretty close thereof. So it might be a buy. We probably should have known that Buffett was going to buy Google from the way he acted in previous interviews. He and Charlie Munger were being interviewed, and they were asked what stock did they miss that they regretted missing, and they almost both said together Google. And it's because with their insurance business, they could see what a difference advertising on Google made for their insurance business, and so they knew it was good. Right now, Google gets 93% of all the searches done. So it's really just dominated in that area. And of course, it's a major part of its business is that it owns YouTube, which is suffering now because corporations have cut back on their advertising. But hopefully that will change in the future. Right now, Google is selling for about $92 a share. Which is about, that's real close to the price that Warren Buffett bought it at. And its price to earnings is a little bit above 17, and that is low for a technology stock. So it would be a reasonable buy right now. Earnings on Walmart and Home Depot, it just came out because Walmart is a good indicator of people's spending in general, and Home Depot is an excellent indicator of how home buyers are, how much money they're spending. And Walmart had disappointing earnings, and Home Depot, they had they missed on revenue that was expected, but they had okay earnings. But both of them were very cautious in their guidance of the future as to what the general economy was going to do. And so You don't know whether they're just being cautious to set expectations low so that when the earnings do come out, they beat the earnings and the expectations, and then their stock goes up. So they might be setting expectations low, or whether it is genuine concern over the economy. It's probably a little bit of both. If you're having trouble guessing which direction this stock market is going, artificial intelligence doesn't seem to be having any better luck. They asked ChatGPT what was the stock market going to do, and first they asked it, when is the stock market going to crash? Okay, and now they put a special code into it, which allowed it to break its own rules. It doesn't like to make predictions about the future, but you have to give it this code so it will make predictions about the future. And they asked, when will the market crash? And this off-brand Chat GPT said March 15th. But then they asked it, when will the market rally? And then it answered, well, in the next couple of weeks. So it seems just to be as much out to sea as to what the market will do as anyone. I wonder if artificial intelligence is going to have just as much trouble as humans do have trying to predict it, simply because there's so many variables involved, and because it is a mass of humans which have a lot of underlying irrationality beneath their rationality. So I think it's going to be very hard for artificial intelligence to try to guess what humans are going to do, just like humans are having trouble figuring out what all the other humans are going to do. The world geopolitical situation has made stock forecasting extremely difficult. Russia and Ukraine are major suppliers of oil, grains, and metals, and those have been intensely affected. And also our relationship with China has been affected because China is sort of an ally of Russia, but they want to put some limits on that. But at times they act like they're going to support Russia fully, and sometimes they back off at our urging. So it's a very complicated situation, but I think if this war ever ends, and I think it will end, but it's just how soon will it end? General Milley, who's the Secretary of the Army of the United States, he predicts that neither Russia nor Ukraine can get exactly what they want out of this war, that it will be very hard for Russia to accomplish all of its goals, and very difficult for Ukraine to accomplish everything it wants to accomplish, and that ultimately they're going to end up at the negotiation table. But they are probably waiting to get in a good enough situation to have the upper hand at a negotiation table. So it's a very complex geopolitical situation, which makes stock forecasting all that more difficult. One thing I heard about the Ukraine war, which surprised me a lot, is that Russia has lost about half of its modern tanks. Wow. Their Air Force is relatively unaffected, but they've lost half their tanks. And the casualties in the Ukraine war are just horrendous. Ukraine has lost about probably a little over 100,000, between 100 and 110,000 men. Russia has lost about 142,000 men. You know, in 8 years of Vietnam, the United States lost about 50,000 men. Okay, so the war over there is just atrocious. And the type of war it is, where Russia conquers towns by completely destroying them, is like going back to medieval times. I keep waiting for them to bring out catapults where they're flinging boulders towards the cities. They might as well be. It looks so medieval, it's unbelievable. One thing that makes it hard to forecast what's going to happen is the economy is giving us just two different views of the economy, depending on what data you look at. If you look at the unemployment rate, historically, it's one of the lowest unemployment rates ever. You know, it's around 3.4% unemployment. That's one of the lowest rates ever. And retail sales are roaring. People are spending money. But then again, if you look at manufacturing has been down the last 6 months. One thing I've been surprised at is what useful information the Federal Reserve gives us about the economy. And the Richmond Manufacturing Index, the Richmond Fed Manufacturing Index, shows that manufacturing has been negative for 8 of the last 9 months. It's either been neutral or negative 8 of the last 9 months. The only exception was December, where it was up 1%. Okay, but most recently, it was down 11%. So you got this going on where retail sales are roaring, people are spending money, and on the other hand, our manufacturing is doing poorly. So it makes it, you would think that would eventually feed through, but there's so many offsetting factors. I think the amount of money on the sidelines is a big factor too, that it comes in and it comes out, and it just depends on how the market's going. And so you get these rallies and then it backs off. And the bear rally, it seems like the major bear movement is mostly over. But on the other hand, to get a sustaining rally going the other way seems to be a major obstacle. And there's another comical indicator that Alan Greenspan, who used to be head of the Federal Reserve, used to look at, and it was how much men's underwear was selling, whether sales were increased or decreased. And he always took it as a sign the economy was doing well if men's underwear was selling well, because men would not replace their underwear during hard economic times. So you have some humorous indicators like that. They've talked about frozen lasagna somehow being an indicator, although I haven't quite figured that one out yet. But you have all these contradictory signs, and right now the S&P 500 is battling it out at 4,000, and I think we're going to be in this battle for 4,000 for a while, because there's no clear stimulating event that's going to cause it to go up or down, unless we have some dark swan, some black swan event occur, and that's always something that could occur, some negative event that comes out of nowhere and takes the market down. But that's something we always kind of fear happening. But it seems like we're not going to get big news on inflation until March, probably. And we will see what the Fed's going to do with the interest rate. Right now, there's about a 76% chance they're going to raise it by 0.25, a quarter of a point on March 22nd. And there's a 24% chance that they'll raise it a 0.5, a full half a point. So they could get back to increasing the interest rates even more, which would be a negative for the market. You know, when there's a rally going like there was at the beginning of this year when the market and the NASDAQ went up 14%, you know, there's the fear of missing out. FOMO, fear of missing out, takes hold, and people jump into a rally because they don't want to be left out. But now people are talking about JOMO, J-O-M-O, and that's the joy of missing out. And that's because you can get near 5% returns on a money market or bond of some type, a short-term bond. And you know, it's you don't have to worry about it. You're not risking anything, and you're guaranteed a 5% return, which hasn't occurred for a decade or more. So it's the joy of missing out. It reminds me of the 1970s. You know, the primary saying in the early 80s, as I remember it, was that cash is king. You know, we've heard for so long now that cash is trash. But when you get into these kinds of situations and you actually start to get interest on your money, hey, it starts to look pretty good that you get a return for taking no risk. And so cash does become king to an extent, at least for a while. That's all I have. Thanks for listening and watching. Smash that like button. Subscribe if you haven't already done that. And hit the little notification bell if you want to be notified of future videos. Good luck to us all. I think we're going to make it through this. I'm waiting for that war to end. That would be the greatest blessing to the world and to the stock market. But until then, we're going to have to muddle through, I fear. Thank you.